We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Kevin Wadsworth and Patrick Karim from NorthstarBadCharts.com. Kevin, how are you today?
I'm good, Tom. Thanks for having us on the show. It's always good to catch up.
Absolutely. Pat, how are you?
I'm doing great, Tom. Thanks, man. It's been a while there, right?
It has. I always say this, and I'm sorry to the audience for, always saying this, but it does blow my mind how long it is between times that we've spoken. I looked back the last time I had both of you on, it was in 2023 sometime. So
that's so much more white hair now, Tom. It's crazy.
Me too.
I was starting to think you didn't like us anymore, Tom. So it's good to be back.
Not at all. It's just there's so many different opinions out there. There's so many different ways to look at all of these setups, and that's what I try to give the audience is a wide range of how to look at these different things. But the reason I wanted to have you guys back is you guys have introduced this concept of a capital rotation event and really put a lot of work into being able to understand what that is, what that looks like, and why we could be on, let's say, the eve of something like this. So why don't we start by explaining a little bit, Kev, about what a capital rotation event is and kind of what you have built this model or based this concept off of.
Yeah, sure. The idea of a capital rotation event is really, it's kind of what it sounds like, really. It's a rotation of capital from one place to another, not necessarily directly, but in terms of sort of the relative performance of two sectors, shall we say. So in this particular case, what we're talking about when we say two sectors is really the stock markets on one side and precious metals on the other side. So what we're defining is a rotation of capital between general equities, stock markets, and the precious metals, in particular, as measured by gold. It's probably easier. It's always the case that picture paints 1,000 words. So I'll show you a picture. I'll show you the capital rotation charts. What you're looking at here is a number of charts. You can see on the right-hand side of the screen there, I've got a number of them just flagged with a red flag. These are our capital rotation charts, okay? And it's a series of pieces of evidence that we put together to provide the evidence case that a capital rotation process is underway. And when all of these little flags turn red, including the bottom two, then we have a capital rotation event that has been confirmed. So this is US money supply versus gold. And when a capital rotation takes place, the chart turns down from a high point and starts descending, or it turns up from a low point and begins rising. And in this case, when it's dropping, it means that gold is outperforming money supply. And when it's rising, money supply is outperforming gold. And that just so happens that at the turning points on this chart, that's when you get the top and the bottom of the bull and bear markets for precious metals. So 2001 was the sort of the bear market bottom, if you like, for gold. And as this chart dropped, the gold and precious metals bull market went into full swing until late 2011, early 2012, when this dropping of the chart stopped and it began to rise again. And that's when the precious metals bull market was over. So what we're looking for clearly is for this chart to break down and drop. So that has happened. Gold has been outperforming money supply since early 2023. And this was one of the first charts that sort of fell into place to tell us that precious metals were going to do exceedingly well. I brought it to everyone's attention when it broke down. And at that point, gold was at $1,600 or so after it hit its high point and started turning down. It's now risen $1,200. It's gone up to, of course, nearly $2,800. So that's money supply versus gold. We've now got the US dollar index versus gold. And when this chart is dropping, it means that gold is outperforming the US dollar index. When it's going up, the US dollar index is outperforming gold. And when it comes down, gold is outperforming the US dollar index. And you can see very clearly these big downward pointing orange arrows that coincide with huge precious metal bull markets when gold doubles, and then it doubles again, and then it doubles again, and then it doubles again. And the same thing happened between 2000 and 2012. The chart plummeted and gold doubled, then it doubled again, then it doubled again. So my sort of thesis would suggest that when this chart breaks down, you have another piece of evidence that we're entering a capital rotation process. Okay, and that has broken down, that has happened. And so this particular chart tells us that capital rotation process is underway. This is gold versus CPI. And when a capital rotation event in favor of gold takes place, the chart breaks through important resistance and starts moving up. And I've marked those with green circles. You can see one there in the early 1970s, and as we've previously said, in the early 2000s. So each of these charts gives its signal at a slightly different point in time, and as they all fall into place, the capital rotation event is confirmed. And you can see the latest major breakout on this chart, where the chart broke out through major resistance and began to move up. So again, this particular chart tells us that capital rotation process is underway. Gold versus PPI, and I'll probably need to pop this onto the quarterly time frame just to make it a little bit clearer for you. So on the quarterly time frame, you can see that gold has broken out versus producer prices. So the chart is moving up through a very, very important resistance level. And when this chart moves upwards and breaks upwards strongly, gold rises hundreds of percent. You can see it happened in the 1970s. You can see it happened in the early 2000s through until 2012. So we're looking at how all of these charts behave during precious metal bull eras, not a bull market. I'm talking about a bull era here where gold goes up for 10 years or so. So we've just broken through critical resistance. So again, this particular chart tells us the capital rotation process is underway. Currency in circulation versus gold has broken down, and that's exactly what you need the chart to do in order to give a signal of a capital rotation event in favor of gold. You can see it broke down in the early 2000s, 2001 there, and you can see it broke down in the early 1970s. So we're looking for this chart to break down, and on this quarterly chart, it's done exactly that, and it's breaking down and heading towards its initial target. So that suggests that gold is going to rise by a very large amount. This is the equal weighted S&P. I'll pop it back onto the monthly time frame. This is the equal weighted S&P versus gold. And what we need for a capital rotation process is for the chart to peak and start dropping, as it did back in the early 2000s there, when gold went from 250 to 450, 500, then to 1,000, and then to nearly 2,000. So it doubled, then it doubled again, then it doubled again. So what's happening now? The chart is breaking down. It's down below the Ichimoku cloud. It's below the 3-year moving average. It's below support. So this particular chart is telling us that capital rotation process is underway. Gold versus the New York Composite Index. This needs to rise and break upwards through important resistance to confirm a capital rotation process is underway. And what's just happened is the chart has broken out above the 3-year moving average, above the Ichimoku cloud, above resistance. So this particular chart is telling us a capital rotation process is underway. The Dow to gold ratio is one that a lot of people will be familiar with, and the capital rotation events are shown very clearly. You had a signal there in 1930. You had a signal in the period between 68 and 72, and you had another signal around about 2001, 2002. And the signal comes when the chart breaks down below support line, below the Ichimoku cloud. I'm just popping it onto the quarterly time frame so you can see a bit more of the chart. And as the chart starts to drop, that is gold outperforming the Dow. And when it does that, it does so for a decade, and it takes a long, long time for the Dow to gold ratio to recover back to where it was. So the chart is breaking down at the moment. It's down below the 3-year moving average. It's down below, on this quarterly chart, the 36-period moving average, and it's just about breaking through critical support at the moment. It's just bouncing on that critical support. So the Dow to gold has broken down, and if I just pop it onto the monthly time frame, you can see it's well below the 3-year moving average and well below that rising support line. So we're just dancing around on this critical support at the moment. The Wilshire 500 has broken down below the 3-year moving average and below the Ichimoku cloud versus gold. And again, you can see that during a gold bull era, the chart plunges, moves down, And that's what we're looking for. We're looking for a clear breakdown and for the chart to move down. And that is exactly what's happened. The chart's broken down below the 3-year moving average, below support, and below that Ichimoku cloud again. The Russell showing exactly the same thing. Early warning being given by the breakdown. So the Russell has broken down versus gold. The final two charts, in fact, I'll show you NASDAQ versus gold. NASDAQ has not made a new high versus gold in the last 25 years. The NASDAQ high versus gold was back in the year 2000. And so despite the rallies that we've had since then, the NASDAQ is still lower on its ratio versus gold than it was 25 years ago. And this is starting to look very much like a topping process here. It hasn't broken down yet, but it's looking toppish to me. And as soon as this chart breaks below this support area where we have the cloud, the moving average, and the horizontal support and resistance line, then we'll be able to give confirmation of the NASDAQ breaking down versus gold. And the most important one of all is the S&P versus gold. And you can see the capital rotation events in exactly the same way as all the previous charts. Rotation as the chart drops, and that's rotation in favor of the stock market. So rotating away from precious metals towards the stock market, rotating away from the stock market towards precious metals, as we did in the early 2000s. So we had a precious metals bull market and a stock market bear market. And then the rotation that took place in 2012, and that took us away from precious metals towards the stock market again. And now we're looking for this breakout. So this breakout here above 0.5 will confirm the capital rotation event has occurred. So we have a capital rotation process ongoing, and this chart and the NASDAQ chart will confirm and give the final confirmation of the capital rotation event. So summarizing all of that, we have a matrix here that shows you everything that needs to happen for a capital rotation event. You need to see all of these boxes turning red. So USM2, DXY, CPI, PPI, currency in circulation, equal weighted S&P, New York Composite, Dow, Wilshire, Russell, they have all broken down versus gold. And it just hinges now on these final two green boxes, which will also trigger the S&P to break down versus money supply, DXY, CPI, and currency in circulation. So the CRE indicator is on 10 out of 16. And as soon as these two final green boxes disappear, this arrow will go all the way down to 16. And that will be your capital rotation event. And that means we will have probably 10 to 15 years of the stock market going nowhere, and 10 to 15 years of gold outperforming the stock market.
Kevin, is that 10 to 15 years of the goal of the stock market versus gold, or nominally going nowhere, as you just mentioned?
Yeah, very good question. So it's stock market versus gold. So for 10 to 15 years, Tom, the stock market would be expected to underperform gold. But what happens is that the stock market drops for a couple of years from past evidence. So there'll be probably a 50% drop for the S&P and maybe 75 or 80% drop for the NASDAQ. And that drop takes place usually over the course of a couple of years or thereabouts. And then on the recovery, the stock market will clearly begin to recover, but it takes many years to get back to where it came from. And during those many years, gold is massively outperforming the stock market. So on that recovery, gold and silver and commodities are in their bull eras, and they're going up by hundreds of percent, whilst the stock market, it might drop from 6,000 to 3,000 and go back to 6,000. So it's fallen 50% and gone back up to where it came from in that time. Mm-hmm. That's based on previous capital rotation events.
Yes.
So, Kevin, when we think about, let's say, what could go wrong here, is it possible that Bitcoin takes a lot of that extra capital away from gold as well? And how correlated is it, or has it been to the NASDAQ at this point?
Yeah, Pat might have one or two charts that he wants to show on the correlation, but
yes.
The simple answer to that is that anything is possible. And I wouldn't rule anything out completely. But what we're going on is based on known correlations and known historical evidence.
Mhm.
We know that Bitcoin is correlated to tech stocks, and can that correlation break? Can Bitcoin start to do what gold does in a capital rotation event? Can Bitcoin outperform on the recovery? Well, Pat might have something to say on that. I mean, you can't rule it out entirely. But all we can do is go on the evidence thus far and track the correlations as time moves on. Because if there's any evidence of the correlation changing and Bitcoin really starting to outperform on the recovery, then that's great. But that evidence isn't there yet.
It's I don't want to say it's nonsense there, but people they're so, I don't want to say people, maybe the Bitcoin maxis. I show them this chart, nobody responds. It's like deer in the headlights when I show them this chart. So essentially, this is the SPX priced in gold. So it's this chart since whatever before the 19th century. And then I have overlaid Bitcoin priced in gold also. It's the black line here. Look, it's like people, I have a 4-year cycle. The Bitcoin's been going up and up. Okay. I don't want to, of course, it's been in a bull run since inception, but when did its inception start? So you have to zoom out for that, right? You got to look at the evidence from the macro perspective, and it's the trajectory. Yes, it's outperformed SPX. It did better than SPX, but its trajectory, the ebbs and flow of that uptrend and that momentum. You see how it's explosive at the beginning, then it slows down. Just like Kevin showed you, SPX starting to roll over versus gold. Well, Bitcoin is practically at its 2021 highs versus gold, right? It's stalling, it's slowing down, right? It's not exploding as fast as it used to versus gold as it did. But this, and now we come back to the capital rotation process, right? Kevin noticed, he explained it here, first capital rotation event where SPX breaks down versus gold. Of course, gold was pegged here. It was primarily SPX dragging down that ratio. Here we had the oil crisis, but that was the second capital rotation event, dot-com bubble rolling over. And then I show this to anybody who wants to listen to me, or mostly the crypto maxis who have huge accounts, because they're not showing this to their followers. They keep saying hodl, hodl, hodl. Yeah, but goodness, are you going to do that? It's fine hodling in an uptrend, but are you going to keep saying that when you don't understand that if the capital rotation, or when it happens, a capital rotation event, that the odds are this will be going down here. Like, I'm not saying Bitcoin nominally goes down. That's probably not what's going to happen, but it will start underperforming gold, right? There'll be other assets where you should be holding instead of Bitcoin. And they just can't see the bigger picture of this. So to expect, from a probability standpoint, to expect something different right now, it's been in there for 15 years. It's been tracking the SPX or NASDAQ or whatever, the leverage SPX or leverage NASDAQ. It's been doing that. And now all of a sudden, because you have a narrative, it's going to do different this time. That's what? That's not how logic works or probabilities work, right? You're going to have, if you've been doing it for 15 years, it's like people say, Patrick, it's the right now, the last 15 years is the chaos before the consensus. And then everybody realizes it's a monetary alternative to gold or to fiat, and it's going to change its behavior. Well, what I'm telling you right now, this is not the chaos before the consensus. I think the consensus has been in your face for 15 years, and that's what it is. It's like people always think the market's wrong for 15 years. The market was wrong for 15 years. That chart it shouldn't look like that, right? If Bitcoin was something else other than, and it has nothing to do with what Bitcoin does, right? It could have been Apple pricing gold. It could have been Amazon pricing gold. It could have been any of these other instruments. It's like you're expecting something different out of nowhere, out of the blue, and you think all these analysts across the planet that are putting their money behind Bitcoin, they're pricing it. They're going to start pricing it in a different way. It just doesn't make sense, guys. It's just a storyline, a narrative people say to keep hodling, to keep stacking, to keep increasing their stack of Bitcoin. And that's, as long as the price of Bitcoin nominally keeps going up, they're going to be fine, these people, right? Even if they're going to be fine. But if there's a capital rotation event, or when it does happen, and Kevin showcased you that we're 10 out of 12 or whatever, it's starting to, when gold breaks down, when SPX starts breaking down versus gold. And I wanted to mention that, Kevin, when you were showcasing those charts, I was looking at Dow versus gold rolling over, equal weighted SPX rolling over, the Wilshire 5,000. Those are the 5,000 top stocks in the United States, all the stocks. It's all the stocks. It's starting to roll over price in gold. There hasn't been one time where SPX and NASDAQ did not follow suit. So I don't want to say it's 100% certainty that SPX will roll over versus gold, but it's never done it before. So when the majority of the indices, the other indices other than SPX and NASDAQ roll over versus gold, SPX has always, and NASDAQ has always rolled over versus gold. So when that CRE event is confirmed by me and Kevin there, when SPX gold breaks out versus SPX, what do you think is going to happen to Bitcoin? Nominally, it's going to take a drop, just like the NASDAQ. It's going to go down, 50, 60, 70, 80%, nominally, price in fiat. Price in gold is probably going to go down 90%, 90, maybe even more. Like, look, this is the chart. I'll show you the chart Kevin showcased you. I'll do it right there live. This is, let's say, the NASDAQ. So here's the NASDAQ monthly. I'll put on the monthly chart. I'll zoom out, right click, reset chart. So here's the NASDAQ in the 2000s. It went down. Yes, of course, it was a huge bubble. So it went down more. The SPX went down 50%. NASDAQ went down 80% here. And then look at that. It did a beautiful recovery. It went up 177% off the bottom. And that's great, you know. If you're hodling a tech stock or a Bitcoin during a drawdown like that, you'll go down 80%. And then you'll have a crazy rally up 177%. Then you went down 55%. And then you went back up. But then I'll show you NASDAQ priced in gold, what it did. And look at that. Put back NASDAQ price in gold. Goodness. Move to new pane above. No, not that one. Try that. Move to new pane below. Check this out. Let me set that up properly. Put back down log, put on log. Look what happened. It was practically a one-way street down, 92% price in gold. I'll put even the candle charts. Maybe we'll see even, I'll be able to make it look even worse. So the rally, even if it went up 177%, the rally, right, from 2002 bottom all the way to 2007 top, price in gold, look at my rally, 44%. But after that, it was downhill. It was just underperforming. So that's what happens when you have a CRE event. Even if nominally people could keep playing the NASDAQ, say, oh, good, I have a rally, it's going up, it's not that bad. Other assets were outperforming the NASDAQ, right? Oil, I could have done NASDAQ price in oil, NASDAQ price in silver. It looks practically the same. Check this out. NDX divided by XAG USD. Look at that. It looks even worse. Look at that. Where's there's not even a bear market rally for how many years? For 11 years. There's no bear market rally for NASDAQ price in silver. Silver was a perennial outperformer for 11 years, and NASDAQ lost 92% of its value.
There's a question here. How long did it take NASDAQ to get back to where it was versus silver?
It hasn't done it yet.
Yeah. So despite everybody getting so excited about tech stocks and everything that tech stocks have done, they still haven't got to the same valuations that they were 25 years ago.
Yes, but we're picking. I don't want to play too much that game of picking our starting point, because now we're picking the most optimal starting point to favor silver in this slide, right? Over long periods of time, this is not the picture, but the idea is it breaks my heart to see people hodl through a 95% drawdown in real terms. And of course, when it's over, when there's a new uptrend, you dump your silver, or you swap. You could keep stacking if you're a stacker, but up here on this breakout, then you go long. NASDAQ outperforms by 800% silver, and then you switch. You switch, flip flop. You do that nonstop. There's no reason to. But people need to look at charts and stop following the narrative. I don't know. I'm on a crusade to kill narratives, because they hurt people, newbies or new investors. People love the story, but when the price doesn't behave and doesn't follow the story, what do you do, Tom? You keep hodling? Like, what's the?
Well, I think these ratio charts are really instructive to understand these longer term, bigger type moves like this. And My question is, though, when we're looking at this type of chart, it's not really like, how do we go, let's say, short NASDAQ and long gold, or do we just own gold or silver at that time, and it's showing you the outperformance of that asset versus if you were only holding NASDAQ?
Yes. Well, a ratio chart. I'll just do this one, Kevin. There, a ratio chart. It tells you which of the two is better to hold. If you absolutely want to hold either, which one is better to hold? Because remember, the ratio chart could go up, and both instruments could be going down in value, right? Versus fiat. It's just that one's going relatively faster than the other up. So it's like usually it's for stackers, the gold silver ratio, or which one is better to hold that can preserve more your value. So if that chart's going up, you just own the one that's outperforming. Don't hold the other one. Why would you just hold the one that's going up?
It works quite well for Bitcoin and gold, actually, because when gold pauses, Bitcoin usually does quite well, and vice versa. So, when the Bitcoin to gold ratio breaks out, it's it's a good ratio to use. You can swap quickly from gold to Bitcoin if you're doing it digitally. I know there's lots of platforms that you can buy a gold and Bitcoin digitally, so you can do it in seconds these days. So that allows you to grow your NAV at a optimal rate rather than having to hodl. As Pat said, when it's a lot more stressful and difficult for most people doing it on daily or sub-daily timeframes. But when you zoom out and you're looking at a weekly chart, for example, you can catch these big trending moves. And if you know that, like at the moment, gold is in a bull market. Okay, so we're seeing a pause, a consolidation. So whilst it's pausing and going sideways for a period of time, why not swap into Bitcoin if Bitcoin breaks out versus gold, which it did do. Bitcoin broke out versus gold, so you can swap into Bitcoin, increase your NAV by whatever percentage, depending on the risk that you take, and then plow that back into gold again. And just keep. There's no need to be sort of evangelical about gold or about Bitcoin or about anything. Just allow yourself the freedom to take advantage of what the charts are telling you. Allow yourself the freedom to be unbiased and swap from one to the other without any concerns.
It's hard to do that, Kevin, though, right? Because when you keep hearing somebody saying, sell your house, buy Bitcoin, sell everything you have, buy Bitcoin, and they're spinning a story like it's the next best thing since a sliced bread, it's like, it's hard to fight that constant, narrative-driven reason to buy something.
Well, it's what worries me is people who tie all of their available capital to one investment vehicle, whether it's Bitcoin or Fartcoin or whatever the flavor of the month happens to be. It's Trump coin, Melania meme, or whatever is the latest flavor of the month, because that kind of risk taking is obviously it's very foolish. I mean, it breaks my heart to sort of see that people are completely blind to the beauty of technical chart analysis and particularly ratio analysis, because I've been saying this a lot on all the podcasts I've been on recently, and I'll say it here, Tom. We're in a gold bull market, right? Gold is outperforming the US dollar. The US dollar has lost something like, 97, 98% of its purchasing power. Gold has not. Gold has not lost any of its purchasing power, not just over the last 20, 30, 40, 50 years, over the last 100, 200,000 years. A gold coin has, roughly speaking, the same purchasing power. Okay, so gold doesn't lose its purchasing power, right? So it's a constant. The US dollar isn't a constant unless you consider constantly losing its purchasing power as being a constant. So why price things in the US dollar? Price things in gold, because gold is the barometer. Gold is the gold is the constant. I don't understand why we now have the ability to pull charts up for anything that you're thinking of buying, whether it's Apple shares, whether it's Meta, whether it's Fartcoin, whatever. We have the ability now to price it in gold on a screen, on a computer screen, easily on TradingView or whatever platform you use. Instead of using the US dollar as your currency, use gold as your currency. Gold is in a bull market, so make sure that whatever you're investing in is in an uptrend versus gold, because if it's not, what the hell are you doing? right? Just don't touch it. If it's not in an uptrend versus gold, if it hasn't broken out versus gold and is displaying strength versus gold, then you're in danger of putting all of your investment capital into something that is at risk. Because in a gold bull market, anything that isn't matching or outperforming gold is at risk. It's at risk of being in this other category of investment vehicles that go into a downtrend versus gold for 10 years.
Mm-hmm. Kevin, how, we talk so much about the US dollar. How important is it to measure gold in other currencies other than the dollar as well?
Yeah, of course. I mean, I'm sitting here in the United Kingdom, so I'm more interested in gold and British pounds. Mm-hmm. So again, pull up the chart on TradingView, look at gold in British pounds or euros or yen or wherever you happen to be in the world, because that's what your local, when you come to sell your gold, that's what you're getting back for it. So that's measuring your own purchasing power in your own local currency. And it's important to note that that the movements of gold in other currencies in a bull market very often lead the movement of gold in US dollars. We've seen gold breaking out in a very, very powerful, meaningful way in British pounds, in yen, in Turkish lira, all because these currencies are weaker than the US dollar, of course. The US dollar has shown quite a lot of strength. But don't you think, Tom, that it's really impressive that in 2008, the US dollar index was 72. Today, as we talk, the US dollar index is what, 108? Mm-hmm. And in that time period, gold has gone from less than $1,000 to nearly $3,000. So over a time period from the DXY going from 72 to 108, gold has tripled in value. So that should make people stop and think, well, hang on a minute, this narrative about, a rising US dollar index is bad for gold. Don't think of it like that. Think of it as a strong US dollar is a headwind for gold priced in US dollars. It pushes against the rising gold price, but it doesn't stop gold rising in US dollars. It just acts as one of those, there are many factors affecting, the price of gold in US dollars: supply, demand, central bank buying, God knows what, stuff that you know about, stuff that I know about, stuff that none of us know about is affecting the price of gold. Mm-hmm. So instead of trying to build those narratives around things that we do know about and things that we don't know about, then what we need to do is just focus on the fact that there are a whole load of other forces that are affecting the movement of gold. And if gold can go upwards in price when DXY is rising, what is that telling us? It's telling us that there is some real underlying strength in what's happening with gold at the moment. I mean, DXY could go to 120, could go to 140. But if gold is still slowly climbing, that's showing real relative strength. It's showing real hidden strength. Just imagine the extra push that it'll get if the US dollar index was to fall from where it is now down to 80, for example. Just imagine being in a bull market when the US dollar index is actually dropping instead of rising. This is why there's a difference between a gold bull market and a gold bull era, which I should have mentioned. A gold bull era is what happens after a capital rotation event has been confirmed. All of this movement of gold from $1,600 to $2,800, that's not a gold bull era. It's a gold bull market, but we haven't crossed the threshold yet because we haven't had the capital rotation event confirmation. So all of this movement in gold has happened, and we haven't even started in a proper gold bull era yet. So imagine when the forces do align, just how much gold is capable of rising. And I might sound evangelical about gold here. I need to remind everybody that I have bought and traded, shares. I bought and traded cryptocurrencies, XRP, XLM, Bitcoin. That I'm completely open-minded about all these things. But what I'm sort of passionate about is pricing things in gold. Price it in gold because gold is in a bull market. And if you don't know what else to do with your capital at the moment and you're completely confused about what's going on, just park your money in gold. We're in a gold bull market. So any pullbacks, even if gold pulls back to $2,300 or even $2,100, something crazy, we are still in a gold bull market that over the coming 5 to 10 years will see your NAV growing substantially.
I've been drawing the gold and versus inversed. So that's gold. I flipped the chart there, invert chart. And that's the DXY adjusted for inflation. So essentially your purchasing power, and gold tracks it inversely. It's slightly, it outperforms it, but the ebbs and flows of gold tracks the US dollar. So US dollar is like a ratio chart, right? It's just half of the equation, right? The inflation is the other half, right? And that's been pretty much the recipe for 70 years there, or since 1970, and I probably before that if I had more data for the US dollar.
So the US dollar adjusted for inflation falling means that the gold chart there will also fall. And because you flip the chart upside down, what that's telling us is that the gold price in US dollars is going up.
That's right. So now it's a combination, Tom, of, let's say the US dollar is strong, but there is more inflation than the US dollar strength, right? And that's often goes together, because there's more inflation, the yields go up. And if the yields of the US are higher than the yields of the other countries in the DXY basket, it will attract capital to hold US dollars. So that will make the US dollar strong. But if there's so much inflation, so when you adjust it and
real returns.
Yes. And then after that, the gold chart represents that purchasing power destruction. It's all a mathematical game. And then there's gold usually front runs that. So if you see gold topping, but then you see the US dollar adjusted for inflation in free fall, it's probably telling you that there's probably going to be a counter trend rally in 3 to 6 months. The US dollar is either going to gain strength or stay flat, and then inflation is going to drop, like a whole bunch of these combinations. But overall, when you zoom out, that's the chart you should show people. Is what does gold track? It's the combination of US dollar strength adjusted for inflation. That's way more important than just US dollar strength, because we've shown it, Kevin, right? In the 2000.com. Well, Kevin's just said it. From 2008 to today, US dollar is up versus other currencies, but gold's also up. So whenever you see something like that, it's because you're not looking at the best correlated instrument, or combination of instruments or charts, racial charts, that looks like the chart, that you're trying to understand what's driving it, But again, it's correlation, doesn't mean it's causation. But as traders, we don't care about causation. It's like, for the storytellers, you could always fit a story. It's the correlation that matters, right? Is it correlated? Yes or no? Well, I could use that to my advantage. When I see correlation, I could trade that. But causation, it's like, what if I'm wrong in my causation analysis? Oh, it's moving because of that. Well, what if I'm wrong? Then I'm
talking about stories. Capital rotation events coincide with stories, and they coincide with a named event of some kind. So if you think about those dates that I spoke about with the capital rotation events in favor of gold, 1930. Well, we know what was going on in 1930. Of course, it was a massive stock market crash and the depression, and it was a huge crisis. The same in 1970, of course, the early 1970s oil crisis and the Yom Kippur War and all that kind of stuff. So, and again in 2000, we had the dot-com bubble. So capital rotation events don't tend to happen without a lot of other stuff going on geopolitically. I'm not trying to attach narratives to this, but I'm just reminding people listening that, it's a turbulent period. Gold gaining this kind of strength versus stock markets doesn't come without some kind of background, shall we say. So just be aware of that, and be, whatever narrative is fitted after the event, the chart is already telling us that this process is underway.
There's always a recession when there's a capital rotation event. So as gold breaks out versus SPX, I'll show you the chart, because people are going to say, you guys, you bring TA guys, where's the charts? I'll build it really fast for you. So here's gold.
While you're building that, Pat, I think Kevin, the point you made that is super important to understand and take a step back or a moment to think about, is this idea that you want to be completely agnostic about whatever asset class you're backing, or you're putting much of your eggs into that basket. And the ability to, let's say, switch back and forth from Bitcoin to gold when one's topping versus the other, I think that's an interesting idea that I have heard before. And, we want to be able to pick the best possible asset in these times of a currency crisis like this, or a capital rotation event, as you're calling it. But the ability to look at these charts to really show you that this particular asset is very likely going to be the best one to pick, I think is really interesting. And that is the important part of being able to be objective versus just narrative driven.
Yeah, I mean, the objectivity, and I've said this before, the objectivity is important. It's critical. In fact, you have to. I've said often that ideally, what we should do, and what we often do, sort of, mentally, is to ignore the ticker. You can see at the top left-hand corner of this chart, it says gold versus SPX, but this chart could be the chart for Apple. It could be the chart for, it could be a chart for the price of bananas, or the price, whatever it happens to be. The techniques that Pat's using here are exactly the same for every single chart. And you'll see along the bottom, it's got the years from 1967 to where we are today. That you can ignore the time frame as well. When you pull up a chart, if it goes from, instead of 1967 to today, say it goes from last week to this week, you get the same patterns, you get the same analysis, you get the same we apply the same techniques. So the process of technical chart analysis doesn't alter because the time frame has changed, or because the ticker in the top left-hand corner changes. You apply exactly the same techniques, the same breakout lines, the same moving averages, the same theory applies to every single chart. And if you can do that, then you remain truly agnostic and truly unbiased. Not easy, I'll admit, but and some people have their favorite investments, but you have to respect what this chart is telling us.
And that's it. So recession. So for that ratio to go up practically every single time, it's because the SPX is dropping hard, and the market is understanding that this 10% drop in the SPX will lead to a 20%, 30% correction. It's like something more nefarious than, a standard short-term correction. Gold holds its ground, probably goes down initially, but less than SPX. So that ratio pops up, right? And practically exactly at the breakout, there's a recession. Even here in that micro recession we had in 2000, look what happened. Exactly when gold was breaking out versus SPX. It's a recession, right? It's a recessionary fear or activity, right? The SPX dropping. And there's practically every single time there's a recession, you could look at a whole bunch of indicators, and I do it like unemployment rate and labor, industrial production. You could look at all real GDP, you could look at all that stuff. But what really happens every single time there's a recession, the market drops. Doesn't have to be a huge drop. Let's say the markets are in a bull run in the 80s and there's a recession, the markets will drop a couple of months, 10, 15, 20%. It won't be that bad. But at CREs, the market drops hard. And like we've shown you that this chart here, it's going to drop hard and for a long time, price in gold. So recessions, gold versus SPX breaks out, but you need SPX to falter. You need it. If SPX does not go down, there's no capital rotation event, and there's no recession. There's none. It's like maybe people will feel there's a recession, but officially declared, highly unlikely. But then after that, you're looking at the Fed already starting to cut rates. They're probably going to cut rates today. They're cutting for a reason, right? Not because the markets are going up. They're cutting because the unemployment rate and all that stuff is starting to, it's trending upwards, right? There's a whole bunch of symptoms. I could find one here. There's a whole bunch of symptoms that we're heading into a recession. Like this one here. Look, this is the unemployment rate, Tom. It's trending off a bottom, moving up. And every single time it started trending upwards, there were recessions at these moments. So there's other indicators, we're not quite there. Probably need a little bit more softening in the economy for the markets to really start pricing in the recession. But the SPX has to drop. It has to. If there's no dropping, it's a nothing burger. We just have to wait it out. And I just want to show you this chart here related to recessions. This is the total public debt on top. So even if the total public debt has been going up from 1966 to 319 billion to 35 trillion, and people say, oh, it's gone up so much. But that's not what really moves markets. It's not something that keeps going up, right? That's like purchasing power keeps going down. It's not a game changer. It doesn't create these capital rotation flows to change these events. It's the rate of change. It's how fast is that changing? And by putting a distance from moving average indicator, and I think at the bottom here, I don't know what it is, the six quarter moving average. When it explodes upwards, that's when you have something that the market has to reprice. And look at that. Every time there's an explosion in the even if it's going up, the total debt, but it's when it accelerates faster away from its 6 quarter moving average, recession, 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 recession here. So it's the reaction, it's the money bazooka, whatever the floodgates, whatever your favorite analyst is going to say. It's the bazooka, the acceleration of money printing or total debt, right? Either by lowering rates, people take on more debt, like whatever the elements are for that total debt to keep going up. It's the explosion of that because they feel there's a recession coming up, right? Because there's these recessionary pressures to save the markets, to save everybody. When that explodes up, that's when you get SPX, NASDAQ, and Bitcoin to underperform. That's when you get gold, silver, oil, the miners to outperform. It's on this recovery. And if you're actually starting a new trend, like higher lows like that from 2001 all the way to 2000. Look, 2011, when the rate of change in total debt, that was the start of the top for gold and silver, right? Once it starts unwinding, then there's no more problems. SPX loves it when this unwinds. Look at that, 1981. Look at the debt. That was the greatest bull run probably ever for U.S. equities, right? All the way down here. And look at the 70s here. That was a bull era for oil, silver, uranium, gold. You see how the pattern, how it works? So here you have a huge macro driver. If this is trending upwards from bottom left to top, bull era, gold, silver, outperform, underperform, SPX, tech, whatever you want, Bitcoin, insert your favorite here. Opposite. But look at that here. If that breaks out, Tom, it's another macro indicator, capital rotation event. Fund managers, money managers, pension fund managers, all of them, they're going to have to start allocating to something that's outperforming, and that will not be Bitcoin and all that stuff. Even if they do go up nominally, it will be the other asset classes. So people always say, oh, exploding debt is good for Bitcoin, it's good for stocks. It's not exploding, guys. By that metric, debt is not exploding. It's like always when I was working in IT, Tom, and then you'd see the budgets. They were asking me what software to buy, and then it costs $100,000, and then I would say, oh man, that's expensive. But I was thinking in my small budget life, for companies, $100,000 is like what we could buy 10 of this software. It's not a problem. So for us to always see 35 trillion debt and see it's huge, well, price in gold, it's not that huge, the debt, right? And you saw the momentum on that debt is not exploding now. It's like going sideways. So it's like, it's a nothing burger again. But when it starts exploding, goodness, that's like, I'm happy it hasn't happened yet because we still have a chance, to start educating or not educating, but, showing people this possibility that what you think was working great for you the past 15 years will not necessarily work great for you in the next 15 years. That's important.
So within one of these capital rotation events, guys, what do you think is a better asset? Like, let's say obviously we've priced everything else in gold, but what about pricing or comparing gold versus silver in one of those eras?
Yeah, well, traditionally, silver has a chance to outperform gold, particularly in the latter stages of a precious metals bull market, and the miners as well. Precious metals miners have a period of time when they will outperform, and that's typically, of course, when speculation comes into the sector and when the general public start sort of particularly taking notice of what's going on. So it's a case of money trickling down to different elements within the space. It starts with gold. Gold, actually, the gold-silver ratio, it's worth mentioning because you brought that up. It's at a very important crossroads at the moment. You pop that up onto the yearly chart, and well, a couple of things jump off the page at you. I mean, the gold-silver ratio has been rising, overall for many, many years. And it's at this very important resistance level at the moment, and is in danger of actually breaking out further. So The gold-silver ratio could well rise, but yeah, at some point during the precious metals bull market, silver has its time to shine, and the GSR is the way to identify that. Just as GDX versus gold is the ratio chart to look at for identifying when to go into the miners. GDX has not broken out versus gold yet. SIL, SILJ, you're doing those ratio charts. They haven't broken out versus gold or the SPX. So you can pull up a chart of GDX versus SPX, just the same as the same way that we did gold versus SPX. So using a ratio chart is a very, very powerful tool for telling you when it's safe to enter the water. If you're going to take a position in the miners, my personal advice would be to stick to the larger cap companies, the ones with a more proven history. I know people like to dive into the micro cap stuff, and it's a little bit like a lottery ticket. And in the full swing of a post capital rotation, in the full swing of a precious metals bull era, then the old adage applies, I suppose. A rising tide lifts all boats, and it's during that phase when you get the crazy moves of some of these micro cap companies going up thousands of percent. But that's not really a responsible way to allocate your funds unless you're just doing it with a very small portion of your NAV. It's not something I would particularly recommend. Mm-hmm. But and also worth also mentioning that overall during that bull run between 2000 and 2012, gold performed equally well as the GDX. So overall, if you start at the year 2000 and you go to the 2012, the gains in gold were the same as the gains in GDX, because the miners had this period of outperformance. Then they gave it all back again after 2008. So in the latter state, later on during the bull market, the miners actually started giving back a lot of their gains before gold did. So, had you just started at the bottom and held right the way to the end, you would have done just as well by holding gold. So you need to identify, using these ratio charts, precisely the exact periods when to get in and when to get out of silver, and the same with the miners.
Guys, what else, if we think about what else benefits in this capital rotation event, is this, an entire commodity complex benefiting time, or is it mostly just gold?
No, it's all I could overlay the oil chart, the silver chart, the gold chart, uranium, copper. I could have put in maybe I don't know, basic materials, like a whole bunch.
I think the CRB index is also, you can put one of those commodity indices on there. The Thomson Reuters CRB index, and there are a number of other commodity indices. And I've often described it like putting popcorn in a pan, and the CRE event happens, and you're putting your pan of popcorn on the heat, and that pan contains all of the commodities, basket of commodities, and pop, they all have their turn. They all at some stage will benefit from the money flooding into hard assets. As they say, if you drop it on your foot, it hurts. It's probably going to do well in the gold bull era. So it applies to industrial metals as well as precious metals, platinum, palladium. But people talk about platinum, palladium, big red flag. They're not outperforming gold. Okay, this idea of positioning early because you think platinum or palladium or whatever is really underpriced versus gold. Well, here's a news flash. It's been underpriced versus gold for a long time. The chart just keeps on going down. The ratio chart for platinum and palladium versus gold has just been, a non-stop one-way sort of down kind of chart. And you could have said at any point in the last 3 or 4 years, platinum and palladium are, very, very underpriced versus gold. Therefore, we should be buying platinum or palladium. And then what happens the next year? It becomes even more undervalued. And then the year after, and then the year after, and the year. So technical chart analysis, it gives you the ability to identify the point at which there is enough evidence to say, right, platinum and palladium now look as though they're in a sustained uptrend versus gold. Let's take a position in platinum and palladium with some confidence, because otherwise what you're doing is you're just speculating and you're just guessing that at some point in the not too distant future, platinum and palladium are going to outperform gold. Well, they probably will at some point, but what about the opportunity cost of having your funds tied up in platinum, palladium whilst gold is going up, they're going sideways? what have you achieved?
These capital rotation events, it's going to unleash the floodgates for a 6-year, 8-year, 10-year, 12-year move. There's no rush, guys. There's no rush. The bulk of the gains, you don't need to catch the bottom, because the risk of trying to catch a bottom and try to be greedy to get that bottom 50% move there, it's not worth it, guys, because you don't have the evidence that you're in a new uptrend. You need higher highs to make an uptrend. Flat plane, a horizontal breakout, that guarantees that you have a higher high. That's the definition of an uptrend. Just wait for that. Then you could ride, instead of trying to catch that 50%, like Kevin said, that 50% could actually go down, and then you have no more capital. Wait until there's an uptrend, let it ride 50%, then you ride 100% to 800%, and the top, you're not going to get it. We're going to either you sell in weakness later and you lose that top, or maybe we do have some techniques to try to pinpoint taking profits into strength, but ride the easy 600, 800%, just sitting back, enjoying life, go play golf, go have fun with your kids. Don't stress about it, and don't try to shoot a bullet and try to get in early, guys. It's suicide. It's a mentality that I have a hard time understanding. I think I do understand it, but I'm numb to it now, because I've drilled my head that the advantages of doing that are far outweighed by the disadvantages. That I'm numb to narratives. I'm numb to these type of techniques of dollar cost averaging in a downtrend. If you're going to do a dollar cost average, at least wait for the CRE and do it after. In the CRE event, you buy the dips probably, or breakouts, corrections in an uptrend. You do that, right? But when you're in a downtrend, you're supposed to sell the rips. These bear market rallies, you sell them until it doesn't work anymore. And it's inversement. How many people have dollar cost average guys and miners that have just kept going down and down and down and down and down, right? And then when you sell, then it starts going up. But you're so far in the hole, if you go down 90%, what do you need, Kevin? You need a 10 bagger to break even, right? It's like crazy. You'll never make it. And then you see your friends making money in Tesla. You see your friends making money in Bitcoin. And then you say, it's a bullet time. It's sad, but don't want that. Please, guys.
As Ronish Dufferley said, and I've brought it up on the show a couple times, we'll leave the bottom picking to the proctologists.
There's no need for it, guys. There's no need. There's no, it's greed. I don't know what it is there. So I caught the bottom, just like catching the top. Mm-hmm. Top callers and bottom callers are nine times out of 10 they're wrong, because they keep trying it over and over. I was right. Yeah, but you tried 9 times on the way down. Same thing on the way up. It's a top. It's a top. It's a top. Because it's hard calling a top, because you're calling a top, you're in an uptrend, because tops always happen in uptrends. So you're not playing the odds trying to call tops all the time. Most of the time you'll fail.
There's no prize for, getting okay, so you feel good when you call the top or the bottom. Okay, great. You feel good, but seriously, as Pat just said, the number of times you'll have to, we all know the accounts on social media, on X and so on, who are constantly calling doom for the stock market, mm-hmm. or constantly, saying that, I don't know, whatever it is that's going to go to the moon, or whatever's going to plunge. You say it enough times, eventually you're going to be right. Of course you are. Mm-hmm. But if you wait for the evidence, wait for the technical chart-based evidence, because, by the way, and if you're watching this and you're thinking about technical analysis and charts and you think it's all voodoo, it just, it's astrology for men and all that kind of stuff, just pause and think for a moment. What is it that's creating the chart in the first place? What is it that creates the support level that we identify and put so much attention on? Well, I'll tell you what's creating it. It's people like you and me and the algorithms that are building the chart out. The chart is built through traders spotting the support and resistance levels and buying or selling them. And the algorithms, the automated algorithms, will do the same thing. They'll wait for a threshold to be crossed, and then the buying comes in. A target is reached, and then the selling comes in. And that whole process repeats over and over and over again. It creates support and resistance, either on a rising diagonal or on a horizontal support line. It creates volume resistance. All of these things that you can identify on a chart and a ratio chart, they're built by the trading action. So when we're analyzing the charts, we're analyzing what people are doing. Okay, we're breaking down the psychology of the trader by analyzing these charts. And it's not that hard an idea to grasp hold of when you think of it in those terms. We're just simply pulling out of the chart the points that are most critical, because we've been able to identify those as the support and the resistance that's been created by the people who are actually writing the chart. We're writing the chart. As the buyers and sellers are in control of where the chart goes. Okay,
that's what I've came to realize, Kevin. A chart trader's goal is not to spot bottoms or tops, right? It's to spot the like. Let's say I was asked you, Tom, draw me the one line you could draw on the chart, the most important one, and forget all the noise. That's our job. And with experience, years, like even there's always failed breakouts and stuff like that, but we're at least trying to put the odds on our favor to try to find the most critical point where if that threshold is surpassed, now the probabilities flip, like that CRE event, that gold versus SPX, gold versus half of SPX, these critical levels that we know that changes the odds in your favor. It could, of course, I was
going to say, just look at the gold cup and handle pattern. Okay, we were drawing that pattern back in 2019 before it had even properly fully formed, because the pattern was starting to become apparent. Okay, the probabilities were that gold was forming a cup and handle back in 2019, 2020, when the COVID low put in a touch point on the arc for the price of gold, and it broke through the threshold on the cup and handle pattern at $2,000, just fractionally above $2,000. What did that tell us as chart traders? It told us that a measured move was very likely to happen from that point onwards. The measured move was about a $600 to $800 move, so the target was instantly, broadly speaking, 26 to 2,800. Look where we stopped. Look where the price paused. These patterns are well documented. It's not me or Pat that is first person to come along and identify these patterns. This cup and handle is actually Wyckoff accumulation, you could call it. You could call it a Stan Weinstein basing pattern. That these chart patterns have been described in a number of different ways by a number of different very experienced technical chart traders over the years, and learning from them and applying the techniques that they've developed over the years. It doesn't tell you with absolute certainty what will happen, but what it tells you is what is most likely to happen. My background is in meteorology, and I've spent my entire career looking at computer models for what's going to happen with the weather in the next week or 2 weeks or whatever. And it's a game of probabilities. If you're trying to say what's going to happen with a horse race or with a weather forecast a week or two from now, then it's a game of probabilities, because you don't know for certain what the outcome is going to be. All you can do is identify the most likely outcome. And when gold crossed that threshold that Pat's just drawn on the chart there, the most likely outcome, because we were above the moving averages, we were above the Ichimoku cloud, we broke out through that important resistance line. All of those are separate pieces of evidence that tell us that the most probable outcome is the measured move. And the measured move is what Pat's just drawn with a grey arrow there.
We're close to it, Kevin, actually.
Exactly. Which is precisely why we're pausing and hesitating at this level. The technical chart analysis and prediction is a game of probabilities. It's a game of analyzing probabilities and analyzing the nature of what the chart is telling us. And if you zoom out on that chart, you can see bull markets occur above the moving averages and above the Ichimoku cloud. Look at that from 2000 to 2013. That's beautiful bull market price action, all the way above the moving averages, above the Ichimoku cloud. That's what a bull market looks like. It looked the same in the 1970s. Above the Ichimoku cloud, above the moving averages, same thing, big bull market moves. And then when the chart fails to break out through important resistance lines, through the Ichimoku cloud, then it is not in a bull market. And you can see that move in the mid to late 1980s, looked for a while there in 1986 like it was breaking out. But we knew this wasn't going to be a major breakout because it was not a capital rotation event. The capital rotation had just happened away from precious metals towards stock markets. And the gold to S&P ratio was not confirming this move. And if you can draw a nice resistance line on the chart there as well. So that the gold to SPX ratio just carried on falling. So this was not a gold bull era. It was a little mini bull run. Gold did well from the bottom to the top, but it was not destined to break out into a multi-year sustained bull market. It just wasn't, the environment wasn't correct for that to happen. Where we are now, the odds are much more in favor because of all of those metrics that I've just shown you, where gold has broken out versus money supply, DXY, CPI, PPI, all of those things that gold has broken out versus tells us that we are in a much healthier environment here. It's never 100%. I'm not going to say there's 100% probability of a capital rotation event occurring this year, but what I will say is that the probabilities and the odds are strongly in favor of a capital rotation event happening probably this year sometime.
We're increasing the odds. The further, like the SPX is stretched. Okay, I'll have to show you this chart again there. I don't know if you want to. I have to show you the SPX there. There's a nuance. I can't believe I'm bringing this point like right now there, but there's a difference, guys, between low risk entries and calling a top and saying everything's going to falter. Look how stretched the SPX is from the it's 36-month moving average, guys. It's all the way up here. So from a statistical perspective, there's more data points here. At the bottom is how far am I from that red line? Okay, I'm going to remove the Ichimoku cloud. I'll remove everything. So the bottom pane is how far am I from that red line? And look, most of the time, the price is below that red line. When you get stretched like that, that's when you start hearing the FOMO stuff, sell everything, buy SPX, whatever, or Bitcoin. You're stretched. But being stretched, it doesn't mean you could stay stretched for a while, right? But the low risk entries, where are they? It's when you're coiled and tight and expanding away from the moving average, right? Here, 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 here. These are the low risk entries. It's when the momentum is coiled and tight and then you're expanding away, that fresh money is coming in, right? And people reading the breakouts, they'll start buying and then they buy and they buy and they buy. When you're stretched and far above, that's telling you that most people have already bought. Unless you're lucky or there's a new wave of money coming in, you're not. The odds are right now is you're vulnerable for a momentum breakdown. So that's the first thing you see before actual price breakdown. It's just that you're not able to distance the moving average as fast as you can anymore. And once you start having that, see, the price could still go up, but you're closing in on the probabilities of having a more important top or correction, they start occurring. And once it actually starts really unwinding, that's when you have either it could be an aggressive correction, the price is still going up, but not going up as fast, or you could have a very bearish correction, right? But this is the thing. Why risk it, guys? As soon as you see that the momentum's falling, starting to falter here you started losing momentum here, but it still kept going up the price, but not as fast. First warning sign. But then after that, when it really started falling apart here, goodness gracious, look at that when it started falling apart. Look, the price was still at all-time highs. It was all the way up here, but the momentum was breaking down. That was another warning sign to, okay, it's time to get out. And when it broke down, there was not a low risk entry point here. There's no low risk entry point for SPX. Look at the NVIDIA. There's no low risk. Look how stretched it is. I've been mentioning this, and Kevin has also. Even when it was up here and the price kept going up, we tell people right here, historically stretched from the moving average, step one. It doesn't mean you short. It doesn't mean, but you don't enter here. Never, ever. Even if the price goes up, the price did go up. It kept going up, up, up. But the momentum was actually breaking down. And now you're vulnerable for either sideways move or one of these 50% corrections there, right? How much did it go down here? 69%. How much did it go here? Went down 50%, even down here, the 2001, 2007 went down 87%, right? So when you have these topping structures on the momentum, distance from moving average, there's no low risk entry. Who's buying? Like, it's not time to buy. It's people who bought lower here on the breakout. They're starting to take profits, right? They've made their money. They're starting to sell into this, right? It's stretch. There's no low risk entry. I don't care if the price goes up. It doesn't mean you were objectively wrong in saying there's no low risk entry. And SPX is stretch, NVIDIA stretch. A whole bunch of these are stretch, even the price. But then think of all the other stuff Kevin mentioned to you. Gold's holding its ground versus SPX. The SPX to gold to SPX ratio is about to break out or hanging in there. You have SPX, the Dow, equal weighted SPX are all breaking down versus gold. And you have the US equity stretched, right? There's no recessions when the SPX is not stretched from moving average. It needs to be stretched. It needs to be exuberant. And then you get these rotation events. So the setup's there. So is it going to roll over in 2025? Maybe early 2026.
I think, as we've had this discussion, it just occurs to me that what we're really looking at is trying to exercise risk mitigation by picking these, lower risk entry points and picking the asset that is most likely to outperform without having to, day trade it, without having to flip flop back and forth all the time and worry about it. It's just this, as you say, participating in an era of outperformance for whatever asset it's going to be. And in this case, it very looks like, or it very much looks like it's going to be gold.
Yes.
Yeah, it does. And a case in point is uranium miners. We do a podcast every week for our members, and we've been looking at uranium miners. And one test that I always apply is the URA index outperforming gold? Mm-hmm. And the URA index has been going sideways to down versus gold for a couple of years now, actually. So until that breaks out, then there's always the risk that the uranium miners will fall further. I don't want to put my money into anything that isn't outperforming gold. I suppose that's the bottom line. I'm happy having my money in gold, mm-hmm. right? And anything that's outperforming it, I will reallocate some of my NAV to that. So Bitcoin, yes, because Bitcoin's been outperforming gold. There are a number of tech stocks that have been outperforming gold, but given what Pat's just said, that's that you can't start recommending entries. But as the CRE event unfolds, you would expect commodities to start one by one having their period of outperformance versus gold, and that includes silver at some point. So, whatever it is you're thinking of investing in, do the gold test. Just do the gold test. It's pretty simple, quick, and easy to do. Because if you don't do it, why are you taking that risk of putting money into something that is not outperforming gold? That goes for uranium miners. It goes for copper miners. Copper has been underperforming gold. Copper miners have been underperforming gold. A whole lot, zinc miners, all these other base metal miners. So wait for the commodity of your choice that you've heard people talking about on social media, and everyone's saying, oh, whatever it is, lumber, coffee, cocoa. When it breaks out versus gold, take your positions in those related companies, but always apply the gold test.
Mm-hmm. Yeah, I like that idea. Always apply the gold test. Well, guys, I appreciate you walking us through all of these different charts and all of your thinking around this subject. Of course, for anybody that wants to learn more from Pat and Kevin, that's all available at northstarbadcharts.com. Excellent resource. You guys chart all kinds of different things from, as you said, these uranium index, individual companies, asset classes, whether it's gold, Bitcoin, different cryptos, all kinds of different things, tons of different charts. And you also take a lot of requests. And I've always appreciated being able to, really lean on you guys as a resource for a lot of this information.
Thanks, Tom. Thank you.
Yeah. Appreciate that, Tom. Thanks.
Yeah. Of course, Kevin on Twitter at Northstar Charts, and of course, Patrick as well at Bad Charts 1. Guys, thanks so much for your time today. Really appreciate you taking the time to walk us through this stuff.
Thank you, Tom, for having us on.
Nice one, Tom. Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.